Let's go inside out now on McDonald's ahead of earnings. Joining us now is Brian Szytel, co-CIO at Bahnsen Group. Thanks so much for joining us today, Brian. So what are your expectations for this report card from McDonald's?
I think tomorrow morning we're going to see about 333 or so earnings per share. That's about a 3% year-over-year growth rate, which, albeit is on the lower end, we've also had a headwind of just rising input costs. Inflation has caused what they serve to be more expensive on the input side. You've also had a rise in labor cost, and so they've been able to absorb a lot of this. And as they come through Q3 into Q4, we feel the company is poised well to continue to execute and come out of that slowdown. They've also enacted some of their more value-oriented side of their menu to try to drive volumes. And a combination of those things, I think, sets the company up to do well. Currently trading at $2.96, you're entering the name at a 2.5% dividend yield. It's got every ability to grow that dividend here over the next 4 quarters.
Okay, so the setup looks good. I mean, it's trading 0.7% higher right now in what otherwise a pretty sort of risk-off type of sentiment type day today. You mentioned some of the rising labor and inflation costs and the fact that they're perhaps well positioned to be able to absorb some of that. How long do you anticipate that they will be able to do that? I mean, what factors are they sort of implementing right now to be able to mitigate some of those challenges? And is this going to tell us what we hear from Mickey D's, that what we heard from Chipotle is a Chipotle problem?
Well, some of those pressures are looking backwards. So we're coming through a lot of them, and that's just an inflation story. Inflation is lower, albeit going forward. So there's some macro benefit on that side of it. But like I said, the addition of trying to drive same-store sales growth through a discounted menu item, at the same time investing about a $40 million position in a marketing budget for their franchisees to be able to offset. There's about a 4 to 5% difference in prices, and so they've got a really well-run business. Their franchisees are obviously very loyal. Their customer is very loyal, so they've got pricing power. And they've already weathered a lot of that inflation storm. So now we're talking about coming out the other side of it with some of these marketing efforts. They've also reenacted their monopoly and membership rewards programs. So they're set up well to go forward. And I would look at more of the inflation story as something that was more backward looking.
Okay, good to know. You mentioned the same-store sales. Obviously, we need to see some expansion there as far as the street is concerned in order to continue to bode well for this company. I'm just wondering, do you have a number that you're eyeing as far as that metric is concerned?
It's a low bar, so we're looking at 2% at this point. So like I said, we like to have a name that's, first off, weathered the storm really, really well. Like you said, I mean, year to date, it's doing just fine. It's up today in a down market because that's what this company does. There isn't anything prettier than a 20-year chart of MCD, okay? So the company has a long track record of this. We own the name for those reasons, but also the ability for the company to return those profits in margins back to shareholders and dividends. They've raised the dividend about 7.5% for the last 5 years. We think that not only continues, but can ramp up a little bit. And the last thing I'll say on margins and some of these pricing pressures is we're talking about a business that runs a 30% profit margin here. So they've grown margins over the past 10 years, albeit they're down a little bit, call it a couple percent from a year ago or 2 years ago. We're still talking about a very healthy, profitable business here going forward.
Okay, so operationally looking pretty good. I'm just wondering, it was McDonald's, as far as the commentary is concerned, last earnings quarter that actually, used the words a bifurcated consumer. I'm just wondering, what you're likely to hear from this company as far as what they say about, how the consumer is spending right now.
At the end of the day, McDonald's, the unemployment rate is low. So the consumers have jobs. They have very healthy balance sheets. They're out to spend. There is a bifurcation on different segments of that market, call it the higher end, folks eating out at more expensive eateries, and on the lower end with McDonald's, those price points and those things matter. And that's why they've come up with the value menu, and they've also brought back some of those fun and interesting things like Monopoly. They haven't had that in about 10 years. And so those things do matter. They drive brand loyalty, they drive volume. And again, you've got high profit margins and you're set up at a business that's trading at about 21 or so times forward earnings. And so all those things I think are tailwinds for the company and the stock itself.
Okay, we'll be watching as we hear from this company tomorrow morning. Thank you so much for that, Brian. Really appreciate the preview and helping us get across that one. Brian Szytel, the co-CEO at the Bahnsen Group. Thanks so much.